I was a commodities trader for many, many years. So I was really able to wrap my head around what was going on in agriculturals or in metals or in grains or what have you. But I didn't really have a full picture in my mind of how to see the associations of what was happening in the US economy. And this, of course, was even before the real big tech boom, but after, of course, the dot-com bubble. And I started to think about the US-centric sectors. And it dawned on me that small caps, for example, were really kind of the granddaddy of the US economy. And if you look at GDP over the last several years, we haven't really had steady economic growth. We certainly have had periods of decline, obviously COVID being a big part of that. But even coming back, we still are not in that area. And that's why IWM, or the Russell 2000, became my granddad. And then I also realized that the consumer is probably the most important part of the US economy. I mean, not just US, most economies, but again, keeping US centric. And so I wanted to really keep it simple, and I came up with XRT because it's a nice blend of consumer discretionary and consumer staples. So it kind of covers you regardless of what the economic condition is. So that's grandma. And then I rounded out the family by what else is really important to see what's going on in the economy, and certainly transportation, borrowing from Charles Dow back in the day. The transportation index, I use IYT, super important, because if you don't know how goods and services are moving in this country, which definitely moves the economy, then you're overlooking an extremely important part. And then, of course, semiconductors, because that's been the prevailing place to be for years and years now. And then I rounded it with regional banks, not big banks, but regional banks, which turned out to be really prescient, particularly last year in March when we had the crash of the commercial bank sector, which really brought down KRE. By the way, SMH is what I use for semis. And then IBD, which is my biotech sector, because I love that. It's both cyclical and non-cyclical in that, depending on what the economic condition is, biotech can do well, like, for example, during COVID, which was certainly a non-cyclical time, but can do well cyclically because when money can go into R&D, those drug companies tend to do better. So that's kind of the whole family right there.
So how do you use them? And maybe just walk us through kind of your analysis going through each of the ETFs and what they're kind of telling you and how you kind of bring it all together.
Okay, well, first of all, I was very fortunate to be up at the office in New York with you guys and Mike last year, and we did a little recording, by the way, on the economic modern family. So I don't want to get too repetitive with that, and maybe you guys can figure out where that is so people can listen if they want.
That's homework for Mike right there, too.
But here's what I do. Depending on the market condition, and I wrote a book called Plant Your Money Tree, where I use the economic modern family, but I also use the weekly charts because they're so key. If you can plot all the different areas that I just mentioned, which are 6, into weekly charts using 50 and 200-week moving averages, then you get a sense of the phase and what is rotating, where cash flow is coming in, where things are flowing out of. When they're all in sync, how powerful that can be in terms of telling you how much you should be invested. And when they start to get more divergent, what that tells you as well. It's all great information. So, this is an unbelievable time right now to be looking at the modern family, because if you look back at 2024 from the beginning, you will see that semiconductors was just on the tear, but yet nothing else really participated at all. So you kind of knew that, have fun in semiconductors, but it wasn't really translating into the US economy because of all the reasons we just said, right? Mm-hmm. If the retail area is not really flying, and the small caps aren't really flying, and the transportation sector isn't really flying, at some point, there's going to be a top in semiconductors, and that's exactly what happened. So how I use the family is, if I want to step back and get a macro, is I look at those weekly charts. So if we go to what's happening right now, We did, over the last couple of weeks, see the retail sector try to move, but it didn't get very far. We saw the Russells try to move, but it completely reversed last week. Same thing with biotech. But meanwhile, semiconductors did top out, and regional banks tried to make a move after months and months of being basically in a trading range. But transportation did not make the move. And this is where the family becomes so important. Because while people were starting to call for 6,000 in the SPY, even with tech going down, saying this was the big buy opportunity, because look at small caps, they're going to lead us to nirvana. I'm looking at transportation going, well, why isn't our good old Tran not participating? After all, we need them to be involved. We need to see robust movement of goods and services. Well, part of it was CrowdStrike. Okay, so that was, definitely more of a watershed moment. But even before that happened, it wasn't participating. So that's when I started getting really cautious. And that's where the economic modern family does really, really well. So here we are in this moment in time, and they're all back on critical life support on their weekly moving averages, whether it's the 50-week in retail, the 200-week in the Russells, the 50-week in semiconductors. The one that has actually broken down and is sitting there desperately trying to hang on for dear life is, guess what? Transportation. So you can look at that and see what happens. If it holds here and everything else held support, along with what I told you with bonds, we should be okay. If that starts to break down, it may be a more than an early warning, more like a sustained warning.
So go ahead, Scott. Sorry.
Cool. I was just curious about the moving averages, because I think that's something concrete that our listeners can use. So you talked about when you said 50-week, I assume you mean 50-day/10-week. Is that correct? Or do you use a 50-week?
I use a 50-week simple moving average.
Wow. Okay. Good.
Yeah.
Good to know.
So
I use a really long-term moving average. Mm-hmm. So definitely going to reduce the noise there. So I would not know where we stand on all these ETFs based on like the 50-week moving average. Or half of them below that? What's kind of the metric that we're looking at now?
Well, again, if we go through 2024, except for the regional banks and transportation, they've all been holding their 50-week and even trying to hang out above the 200-week. But the position of the moving averages is also important, because in the retail space and in the small cap space, in a bullish market on a weekly basis, you want to see the 50-week above the 200-week, or what we call a stack. But to date, most of the modern family members have the 200 above the 50, which means they're in accumulation, but they're not bullish yet. That's also more information. So right now, not only did they not really hold, but they're back testing that 200-week, which, remember, is above the 50-week in those three critical areas. But now transportation is breaking down, especially if it breaks down under, let's say, IYT 61 this week. Mm-hmm. That will be the first one to break down under the 200-week. And again, when one of my premier members break down on a weekly basis, yes, it's a bit of a longer view. And I use the daily ones as well, the 50 and the 200-day. But from a longer term view, it's extremely helpful. Especially, like I said in the very beginning, which we talked about, is people don't know whether or not we're risk on or risk off right here. Things are that delicate.
Yeah, and it's kind of like what Scott said, where it reduces the noise. You're not going to get too many signals if you're using really long-term moving averages. But Mish, when was the last time? Now, do you need all of them working, or when was the last time enough gauges were headed in the right direction that it was telling you, yeah, this market is healthy?
Well, I have not seen them all working together in quite some time, by the way. They did in 2021. Let's talk about that.
Yeah.
When we were coming out of COVID and the Fed was feeding money to everybody along with the government, then everything was flying. Right. And that was an incredible time to make money. And a lot of people
before that, where
like before 2020,
because obviously, before 2020. I mean, after 2020, it's just been obviously unusual. Okay. But yeah.
Well, let's talk about. All right. So it's always great to look at Well, usually one will trigger first. So if we go back to 2008, by the way,
Okay.
you know, what after we got through all of that in 2009, when we started to bottom,
Yeah.
in 2009, 2010, you really started to see, and I'm saying this off the top of my head. I mean, obviously, I would like to look at the charts from back then and to be more confirming on this. But that's really when I started getting super bullish, because all of the family was starting to move up at that point. Semiconductors were bottoming them out, although they took a little bit longer, interestingly enough. They bottomed out in like 2012. But
Yeah.
retail and small caps and the banks and biotech all started bottoming out first and moving together. But really in the last, I don't know, since like 2016, 2017. 2017 was another one, by the way.
Yeah,
Everything moved up together in 2017. That was another crazy year to make money. It was like throw a dart at anything and you were going to make money. But since we had that Fed taper tantrum in 2018,
Right.
and then into COVID, and then since COVID and since 2021, we've been very bifurcated. Which is why you have to watch the complexion of the market change. This was very much a year where in the beginning of the year, buy anything that was moving. Momentum stocks were in high gear because you had all the retail money piling into it. But for those of us who are watching the family, we're saying, hey, well, you know, take profits on the way up, because it wasn't really a good sign for the economy. It was just more of a sign of herd mentality, people piling in because they thought AI was going to be like save the world from like everything, which it might, but I think it got a little ahead of itself, right?
Right.
Based on what the rest of the family said. So I guess the best thing is I like to tell it as a story. I'm a storyteller. And the story, what we're being told right now is the tech valuation has come off a lot, and we still don't really know if this is kind of the bottom right here and the great buy opportunity, or whether we're going to see another leg lower and find valuations at much cheaper, because AI costs are starting to go up, by the way. And that's not something you're hearing very much about in the media. The story we're also being told is right. The transportation system, whether you want to blame CrowdStrike or whatever, the consumer in terms of its buying is getting stretched. We know about credit card debt, but the retail sector could also be a very, very telling sign about what's happening in the economy right now. The cracks from the higher for longer and the higher interest rates that people have had to pay on credit cards. In that story, what we're seeing is that could relate to tech. Are people going to continue to go buy new equipment to keep up with the growth in tech, or are they going to get tapped out? So my story right here is the small caps, the economy, everything right now is telling me don't get too excited. And the Fed might have waited too long, but if they reduce the rates now, the family is going to say, whoa, 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 Chicken Little. Does that mean now they're really, really worried? And that's kind of where the story that I'm seeing the family tell right now. But they're a little bit still somewhat optimistic in that they're hanging on for dear life in hopes that this all just sort of goes away. We don't go into major war, Iran and Israel. That's a whole other thing. Or the yen carry trade doesn't necessarily go through another leg down and bring us down because we're so tied in. And also, let's not forget even just the supply chain and weather issues that we're having across the world right now as well.
So would you use these signals to trade these ETFs, or would you use these signals as an overlay that, okay, the SMH is giving me a bullish signal, and I'm just throwing this out there as an example. Therefore, I want to find the leadership in the semiconductor group. And lo and behold, there's NVIDIA, that's leadership. That would be the stock I would buy. I'm curious about like the execution of this ideas of this tool that you have.
That is such a great question, Scott, because the answer is both, right? I will, and one of the things, my fantasy is that we get, Market Gauge has created a lot of quant models using TSI, and we're working on one for the economic modern family, which would probably start out as a long only type situation. So to answer, I am kind of the quant model right now in my brain. And yes, I will buy, and I will even recommend in my writing or on Twitter or some of the media I go on, which part of the economic modern family is getting ready to move based on a breakout, whether it be on a daily chart or on a weekly chart. I can use monthly too, but we can talk about that another time. So like, for example, right, when semiconductors were starting to make the move, just like you said, NVIDIA, when really things started moving in November and December 2023, and then continued in 2024, that was the only really great place to put your money. And so that would have been a trade, which we did make. And I would have kept my eye on the rest of the family to see if it sputtered. And there was a couple of times where it did, mainly after it got started, but the small caps sputtered in April along with retail. That gave us a little bit of a fear. We got out of some of that semiconductor stuff and then got back in. So there's two ways to use it. One is, right, to follow the trend. And the phases are extremely powerful. These weekly moving averages work great if you're a longer term trader. And on a daily basis, they work great if you're more of a mini swing trader. But if you're really baffled by the bifurcation of the family, then you're now using it more of information and you're sitting mainly in cash until you see a clearer path.